My name is Jeremy Rowe. I'm the chairman of Bully Banks. This is the latest of our video updates. Last week we met the Financial Ombudsman Service and had a debate about certain of the issues which are arising under the Financial Ombudsman Service's decisions on both interest rate hedging products and hidden swaps. We went to the meeting with Nick Stoop from Warwick Risk Management, and we wanted Nick to be there to explain with the authority of somebody who is a derivative expert, to explain to the FARs why we believed that swap for a swap redress is always inappropriate when we're talking about a sale of this product to an SME. The explanation which Nick gave to the FARs, which was very well received and was a very good presentation, was such that I thought it would be helpful if I discussed with Nick the content, the principal content of the presentation, and we videoed it and allowed members to see and hear part of the presentation. So now we're going to turn over to Nick and welcome him. The first question, Nick, is the simple question: why do you believe that swaps are not appropriate products to be sold to SMEs?
The answer to that is to do with the risks of the product. Swaps and collars are complex financial derivatives which impose significant risks on the purchaser. In order for the sale to make sense from a compliance point of view, the purchaser must, one, be able to understand the risks he's getting into, two, must be able to measure those risks on a regular basis, and three, must be able to control them. Logically, if a financial product exposes a customer to risks that he doesn't understand, can't measure and can't manage, it can't be an appropriate product for the customer.
What are the risks that it exposes the customer to?
Swaps and collars include a long-term liability. The customer has essentially insured the bank against falling interest rates over the long term. So when interest rates fall, the customer is faced with heavy losses. And against the possibility of those heavy losses, the bank must take an additional charge over the customer's assets, which in turn restricts the customer's flexibility. Whether it be the flexibility to repay his loan, which may be blocked if the costs to escape the swap are too high. It may be the flexibility to sell assets as and when required. For example, should he get a good opportunity to sell an asset at a high price, this is something he'd like to do for his business. Alternatively, it could be a personal event in the life of one of the directors of the company, maybe a marriage, an illness, or a child going to university. The need for flexibility is probably greater for a small company than it is for a big company. So the loss of flexibility is therefore more of a problem for a small company.
Right, and that's the major risk. If we talk about the small business being able to monitor, what do you mean there?
The valuation of a swap or a collar depend on a number of factors, not all of which are immediately apparent to a small business. These might include the structure of the long-term forward interest rate curve, the market's future projections for forward volatilities. Changes in these factors can cause very large fluctuations in the day-to-day value of the swap. Measuring these fluctuations is beyond most small businesses. The data is not publicly available, it's not printed in newspapers or even online. In order to accurately measure the risk of a swap or a collar, a trader really needs to have access to a sophisticated trading system, something like Bloomberg or Reuters. These systems are not generally available to small businesses. I mean, they're expensive and they're not needed for anything.
And presumably, if he monitors, the SME must monitor very regularly.
Yes, I mean swap traders monitor their positions on a continuous basis. I mean certainly every day, but during the day as well. Because the changes on a 10-year swap, a 1% movement in interest rates can cause a 10% or nearly 10% change in the value of the transactions. On a £1 million swap, your mark-to-market could be going up and down by £100,000 on a daily basis.
Right.
This is a risk that needs to be monitored.
And what about controlling the risk? What do you mean there, that the small business or SME has to be able to control the risk?
Anybody using swaps will use them as a form of active risk management. So to control the risks in the swap or a collar, he may enter into offsetting transactions in the other direction. He may reduce the size of his original transaction. He may increase the size of offsetting transactions in order to keep himself within risk limits with which he's comfortable. This active risk management strategy is only feasible if you're able to buy and sell swaps without incurring substantial dealing costs. Between banks, there's virtually no cost to trading swaps. The dealing cost tends to be less than 1/100th of 1%.
Less than 1/100th of a percent?
Yes. Whereas the dealing costs faced by a small business will be substantially higher, up to 0.5% per annum on the transaction. So on a 10-year transaction, the cost of dealing could be between 4 and 4.5%, £40,000 to £45,000 in the case of a £1 million swap. These very high dealing costs make it unfeasible to use swaps as an instrument of active risk management.
Right, so the very high costs, the transaction costs imposed by the banks, are of themselves the reason why these are wholly unsuitable products, because the people cannot control their exposure to the product because of the transaction costs.
Yes, it's also the reason why small businesses are attractive sales targets from the bank's point of view, because the bank is able to add a margin much greater than it would make through normal dealing.
Okay.
But the fact that the small business is paying so much for the transaction is an indication that it's not an appropriate transaction, because A, it shows that he doesn't understand it, B, that he can't measure it, and C, it's proof that he can't control it because he's unable to use swaps to manage the risk. Okay,
so we have a clear statement that in order to be appropriate, the SME must be able to understand the risks, to monitor them and to control them, and he can't. So the deduction from that is that a swap is always an inappropriate product for an SME.
It's always an inappropriate product for a company that doesn't understand the risks, is unable to measure them, and is unable to control them.
Right.
That is the case with most of the companies in the review, if not all of them.
Right. So that's why one would argue that a swap for a swap as a redress within the FCA scheme is inappropriate.
If the swap is an inappropriate product, yes.
Yes. Why is a cap an appropriate product?
A cap is an appropriate product for a small business because it's transparent and it's simple and it's risk-free. For the payment of a single premium, normally at the beginning, the borrower can obtain long-term protection when interest rates rise, but will still have the full benefit of low interest rates when they're low like they are today. And because there's no risk involved in a cap, there's no loss of flexibility.
Right. And you've made the point to me before in conversation that in fact a cap is a better product for the bank, from the bank standpoint.
Yes, because if a bank enters into a swap with an SME, the SME incurs a long-term liability to the bank, and the bank has to allocate scarce and expensive capital to support this position. This is not the case with a cap. There is no risk in a cap, no capital allocation. It is actually a better product from the bank's point of view in many ways. Right,
so the only reason the bank would ever have for selling a swap rather than the cap is the profit opportunity that it perceived.
Yes, I think the simple answer to that is yes. Yeah. The appropriate product for these companies is a cap. The temptation for the salesman is to sell a more complex product like a swap or a collar or a structured collar or a callable swap or a knock-in digital floor, because these products are very high margin from the bank's point of view. So the salesman will earn himself a better bonus by selling that product.
One of the things you said at our meeting with FOS was that it was an indication of the inappropriateness of the swap, that the added value which the banks put onto the cost of the swap more than covered the cost of a cap. Could you explain that?
Yeah, well, the cost of a swap to the customer is not it's not immediately visible. He doesn't actually make an upfront payment for the swap, but what he does do is he agrees to make a series of future payments which are expected to yield a significant profit.
Actually, no, the way you express that is very interesting. What you're saying is that the swap, at the time it is sold, there's no immediate liability, but it is anticipated that it will produce a series of payments to the bank in the future.
Yes, yes. I mean, that's how the swap is valued, according to the expected future payments over the life of a swap. So while there may not be a payment on day one of the swap, the value of the transaction depends on the expected future payments. It reflects where the market thinks the future interest rates are going to be.
Right.
If a counterparty pays 0.5% higher than the market rate, then the bank is anticipating on average that the bank will receive 0.5% per annum from the client as profit under the transaction. Now this 0.5% per annum over 10 years could be equivalent to 5%, 4.5% up front, and this is how the bank books its profit on the transaction.
Right, so if you've got £1 million transaction, it books 4.5%, 45, £50,000 up front.
That's typical of the swaps that we've seen in the
Right, so that value which the bank has obtained to the transaction may well be more than it would cost the SME to purchase a cap to cover the liability.
Oh, for sure. In 2007, a cap at 7%. Say September 2007, capping your interest at a rate of 7% would have cost something in the region of £5,000 per million covered. So £50,000 on a swap is vastly more expensive.
Right. And so the bank is actually putting the SME into a position where it's paying to assume a liability a multiple of what it would have paid to buy insurance in the marketplace at that time.
It's often the case that the built-in profit on the swap would have been more than enough to buy an appropriate cap.
Right. Okay, thanks very much indeed.
My pleasure.
I hope that you found that conversation of value. Nick has put into very clear terms why a swap is an inappropriate product for every SME within the FCA redress scheme. It is an inappropriate product, it's quite clear, and the reasons why it is inappropriate go beyond the term, market conditions, the particular strike rate. They go to the heart of the product. It is always inappropriate for an SME, and that is why it is entirely wrong for it ever to be part of the redress which is provided to an SME who has been missold this product, redress provided under the FCA redress scheme or by the FOS. It is always wholly inappropriate for there to be a swap for a swap. Thank you.